Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 23rd, 2025. I am Luna.
I am JPMorgan. S&P 500, it just hit a brand new record high.
Right.
But when you dig a little deeper, you find these real undercurrents of fragility, maybe even divergence in the market.
Absolutely. It looks strong on the surface, but there's a lot going on underneath.
So our mission today is to unpack the daily market recap for July 23rd, 2025. We'll focus on two big things: that major U.S.-Japan trade deal and the Federal Reserve kicking off a review of capital rules for the big banks.
And what it all means for you, the investor. It's really a case study in how macro policy creates these, uneven playing fields. You can't just look at the headline index anymore.
Yeah, definitely. I mean, look at the numbers. S&P 500 barely up, like 0.06% for that record close. But the NASDAQ flipped almost 0.4%. And the Dow Jones, it rose modestly, 0.4%. It makes you wonder how solid this rally actually is.
Well, and the key thing is what propped up the S&P. It was really those heavyweight tech names. Again, lots of optimism around AI spending still. But compare that, like you said, divergence. Look at traditional industrial sectors. They're showing real strain. General Motors, for example.
Oof. Yeah, what happened there?
Their shares plunged over 8%. They announced a huge $1 billion quarterly hit just from tariffs.
Wow, $1 billion.
Yeah. It shows even the giants feel these trade headwinds. And it wasn't just GM. You saw pressure on Ford, RTX, Lockheed Martin too. It really paints a picture of a market kind of carried by a few big winners while others struggle.
That is a stark difference. And quickly on other assets. Gold edged down a bit, maybe 0.3% to around $4,420 an ounce.
Okay.
The 10-year Treasury yield, that jumped up about 7 basis points, landing at 4.36%.
Yeah, yields climbing.
WTI crude gained a little, 0.4%, hitting $65.60 a barrel. And Bitcoin, it climbed nearly 2%, up in the $119,000 range.
Right, a mixed bag across the board.
Definitely. So with that market picture, let's dive into that first big macro story. The U.S.-Japan trade breakthrough. What are the details?
Okay, so the core of the deal is this. The U.S. cuts planned tariffs on Japanese goods. Instead of 25%, it'll be 15%.
15.
And in return, Japan commits a really significant amount, $550 billion, to investments here in the United States.
Wow.
A key point is autos. That tariff drops to 15% from the threatened 25%. Plus, Japan opens its markets more and partners on strategic projects like an Alaskan LNG gas pipeline.
And the markets reacted pretty fast, didn't they?
Oh, immediately. Japanese stocks surged. The Nikkei index jumped 2.6%. Toyota stock went up over 11%.
11%.
Yeah, and Honda, Nissan, they were up around 8% too. The yen got a bit stronger, and U.S. stock futures saw a modest lift as well.
But, is everyone happy? Are there any potential downsides here, maybe for Japan, that the market's kind of glossing over in its excitement?
Well, the pushback came pretty quickly from the U.S. side, specifically Detroit.
Ah, the automakers. Exactly.
Their representatives basically said, look, giving Japan a lower tariff rate, this 15%, when Canada and Mexico are still facing 25% on our vehicles. Well, they called it a bad deal for U.S. industry and auto workers.
So their worry is cheaper Japanese imports.
Precisely. They're concerned it could undercut American-made cars and trucks, hitting sales and profits for GM, Ford, and Chrysler down the road.
Okay, so trade tensions potentially easing in one area, but maybe new friction elsewhere.
Yeah.
Now, shifting gears, the other big piece was from the Fed, right? Jerome Powell.
Yes. Chair Powell announced a big initiative. It's a comprehensive review, they're calling it an integrated review, of the capital requirements for the large U.S. banks.
Integrated review, what's the goal there?
Well, Powell said it's to make sure all the different pieces of the capital framework work together effectively, but, it really highlights this ongoing tug-of-war.
Between the banks and the regulators.
Exactly. Industry insiders, the banks, they're hoping this leads to softer rules, could save them billions in capital they have to hold. But Fed officials, and frankly many outside experts, are warning against weakening those buffers. They argue easier rules could make banks less resilient, in the next crisis.
And this comes after the banks already pushed back on that Basel III endgame plan, didn't they?
It does. They successfully stalled that plan, which was designed to significantly raise capital minimums post-financial crisis. So the context here is important.
So for listeners, what's the takeaway? How does this Fed review actually affect, regular investors?
Well, the main thing is potential uncertainty for big bank stocks. If banks face higher capital needs or even just uncertainty about the rules,
Right.
they might pull back on things like share buybacks or dividend increases to conserve capital. That could weigh on their stock prices. It might also affect bank debt, particularly subordinated debt.
And maybe tighter credit overall.
Possibly, yeah. Indirectly, it could lead to slightly tighter credit conditions across the economy if banks become more cautious.
Okay, so looking at the bigger picture then, we've got some positive signs, like the easing U.S.-Japan tension, record stock prices suggesting risk appetite is strong.
Hopes for maybe more trade deals, maybe an extension on China tariffs, decent Q2 earnings.
But there's still significant risks lurking, aren't there?
Oh, absolutely. This Japan deal is just one piece. You've still got these other tariff deadlines looming. Mexico, Canada, the EU. Those could hit the markets hard if deals aren't reached.
So the trade war isn't really over.
Not by a long shot. It feels like it's just shifting. Plus, you have this Fed uncertainty for financials, and those rising 10-year yields could start to pressure stock valuations more broadly.
So the message seems to be, yes, the market hit a record, but it comes with a definite handle with care label. This surface prosperity underlying divergence really means you need to stay diversified, don't get complacent.
Right. And maybe a final thought to leave you with. Given this stark split we're seeing, between the high-flying tech stocks and these struggling industrial sectors, how might you strategically adjust your own investment approach, especially with more tariff deadlines coming up and these potential changes to bank rules on the horizon? Something to think about. Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.